Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Hello and welcome. Now, as many of you know, qualifying for the lifetime capital gains exemption, well, it's a huge deal. It can literally save business owners close to $1 million in taxes. But there's a catch, a really big one that trips up a lot of people. It isn't just about meeting certain tests on the day you sell your company. No, it's about this crucial 24-month period before that sale. So today, we're going to dissect the 3 critical tests you absolutely must pass every single day for 2 full years without fail. Okay, so here's our plan for today. First, we'll cover the one foundational rule that underpins everything. Then we'll walk through the 3 big tests: ownership, control, and the asset test. And we'll wrap it all up with the key strategic takeaway you need to remember.
All right, let's dive right in. Before we even get into the nitty-gritty of the 3 tests, we have to talk about the single most important principle here. It's the foundation for this entire 24-month period. I'm talking about the rule of continuity.
And this is it. This is the big one. It's not a snapshot test. It's not something you just check at the end of the year. No, the CRA demands perfect compliance for all 730 days leading up to that sale. I mean, just think about that for a second. A single day, one day of noncompliance can disqualify you and reset that entire 2-year clock. It's a huge deal, and it's exactly why proactive, continuous monitoring is absolutely non-negotiable. So let's tackle our first major hurdle, the ownership test. For that whole 24-month period, the CRA has really strict rules about who is actually allowed to own the company's shares. So let's look at the 3 ways this can work. All right, it's pretty straightforward, really. To pass this test, the shares have to be held in one of these 3 ways, and only these 3. So that's directly by you, through a partnership that you're part of, or by someone the tax code calls a related person. Let's break each one down. Okay, first up, direct personal ownership. This one's the easiest, the most straightforward case. If you personally own the shares for that full 24 months, you're golden. You pass the test. Think of this as the baseline. Next up, the rules are smart enough to know that not everyone holds shares directly. So ownership through a partnership is also allowed. This is really key for businesses that have, multiple owners or maybe more complex holding structures. And finally, option 3. Now, this one is really interesting because it offers a lot of flexibility. The shares could have been owned by a related person. This is a huge deal for things like family succession planning, but, and this is a big but, it all comes down to the very specific definition of related according to the Income Tax Act. Which, of course, brings us to this. This is where a lot of people get tripped up. The tax definition of a related person is probably not what you think it is. It's not our everyday idea of family. The CRA has very precise rules about who's in and who's out. So who exactly counts? For tax purposes, we basically break it down into 2 main buckets: people related by blood and people related by marriage or a common law partnership. Okay, take a look at the related by blood category. You'll see a pretty clear pattern here. The rules basically follow a direct vertical line on the family tree, right? Parents, grandparents, children, they're all in. Your siblings too. But notice who's out. Aunts, uncles, cousins. Those more horizontal relationships are explicitly excluded. And now here's the really quirky detail, the one that surprises everyone. Your sibling's spouse, they are considered related to you for tax purposes. Weird, but true. Now, what about through marriage? Well, the logic here is actually pretty simple. Just think of anyone who is a blood relation of your spouse. So that obviously includes your spouse's parents and siblings. And yep, using that same kind of quirky logic from before, it also includes your spouse's sibling's spouse. It's all about those connections. Okay, on to our second test, the control test. Now, if you've looked into the LCGA at all, this one should sound pretty familiar. Why? Because it's the exact same requirement that applies on the day you sell. It's all about the legal status of the corporation itself. And here's the rule. For that entire 24-month period, your corporation has to maintain its status as a Canadian-controlled private corporation, what we call a CCPC. This isn't just a minor detail, it's a foundational requirement for the entire capital gains exemption. The easiest way to think about this test is to look at what breaks the rule. What makes a company not a CCPC? Well, it can't be controlled directly or indirectly by non-residents, by public corporations, or by some combination of both. As long as you steer clear of those scenarios, you'll be fine on this test. All right, now we've arrived at our third and final test for the holding period. And honestly, this is often the trickiest one. It requires the most careful, ongoing management because it's all about how the company's assets are actually being used day to day.
Okay, so right at the moment you sell the shares, the test is incredibly strict. The rule says all or substantially all of the assets must be used in an active business. And what that means in practice is at least 90% of their fair market value. We're talking about the core stuff here: equipment, inventory, the bank accounts you use for operations. It's a very, very high bar to clear.
But, and this is a huge but, during the 24 months leading up to the sale, the threshold is much, much lower. The requirement is just that more than 50% of the asset value is used in the active business. And this is so important because it gives the company breathing room. It means you can hold some significant passive assets, maybe a stock portfolio or just excess cash from profits, without blowing up your eligibility. This difference is absolutely critical to understand. This table really lays it all out, doesn't it? It shows you that the asset test is really a two-speed test. For 2 years, you have this flexible, more than 50% rule that lets the company build up some passive wealth. But then, as you get ready to sell, you have to hit the brakes and get serious. The company needs to be purified, and that's a term we actually use. That often means paying out big dividends or bonuses to get those non-active assets out, so you can push the active ones over that super strict 90% line right at the finish line. So, okay, we've gone through all the rules. What does this all mean for you as a business owner or an advisor? If we put all 3 of these tests together, what is the one key insight you absolutely need to walk away with?
And here it is. This is the big one. Getting your company purified to meet that 90% test right before you sell, that's a sprint. It's a one-time, predictable event you can plan for. The real challenge, the one that people so often overlook, is the marathon. It's maintaining that more than 50% active asset level day in and day out for 730 straight days. And that requires a real, proactive, long-term financial strategy. It's not something you can just scramble to fix at the last minute.
So let's just recap with a final checklist. To qualify for this incredible tax exemption, you have to be able to confidently put a check mark next to each of these 3 things: ownership, control, and the asset test, for every single day of those 24 months leading up to the sale, no exceptions.
And so that really leaves us with the essential question, doesn't it? It's not about, does my company qualify today? The real question is my financial strategy built to pass these tests every single day for the next 2 years? That's the mindset you need. I truly hope this explainer has given you the clarity you need to navigate these very complex but very critical rules.